Welcome to another edition of Focus on Alternatives, sponsored by ADISA, the Alternative and Direct Investment Securities Association. For more educational content like this, please check out the resource library at adisa.org. My name is Greg Mausz. I'm your host today, and I'm joined by Jade Miller. She's the president of Capital Markets at Bourne Financial Group. Jade, pleasure to have you here today.
Greg, thanks for having me. Excited to be here this morning.
So Bourne Financial is known for their work and investments in senior housing. So that's what we're going to be covering today. Can you just start off telling the audience what is senior housing?
Yeah, I think there is a broad question on what is senior housing, what does it look like, and what is that range, right? There's this new emergence of 55 plus. That is not senior housing. That is going to be more multifamily for the aging population. Senior housing traditionally starts at what we call independent living. Then there's independent living, assisted living, memory care, and you can go up to skilled nursing. We do not consider, and the industry does not consider, skilled nursing as senior housing. I think that is a broad misconception. Skilled nursing gets more into a medical model, whereas senior housing is more of a hospitality-driven asset class. Think independent living, it's more than 55 plus apartments with some care aspect to it. And then as you age into assisted living, that is where you're going to have more care types, more medical type staffing and activities driven around that. And then once you get into memory care, that is going to be your highest acuity type of senior housing. So senior housing really has a range from independent living to memory care.
And this has gotten all parsed out over the last couple of decades as the U.S. population continues to age. Senior housing was one of the hardest hit sectors in the pandemic. Has the sector recovered? What lessons were learned from the pandemic experience?
We have had a hard 4 years. I think I speak for everyone in senior housing when I say we are finally starting to see the light. Most people think the pandemic and you immediately jump to hospitality as being the hardest hit industry. I would argue that senior housing, second to office, was easily the hardest hit, only because we had multiple factors that come in. So I mentioned skilled nursing earlier. Skilled nursing was what everyone saw on the news as where people were passing away or COVID cases were overwhelming the population. That was all skilled nursing. Those, again, are more medical. You cannot place people in an independent living, assisted living, memory care, private pay communities the way the media portrayed. So that is not what happened to senior housing. But what did happen is that you could not move people in, right? So we had government shutdowns, and these were driven state by state. So some states were hit harder than others, but we could not move people in, but mostly we lost our value proposition. So I mentioned senior housing as a hospitality-driven industry. The biggest part of senior housing is the advantages that it brings to its residents as far as community involvement. That is one of the things that if you look at studies for seniors, for aging, the more involved the older population are with each other, the more interaction they have, the longer lifespan, the better health. So that is one of the biggest advantages of senior housing. We did not have that, right? You could not leave your room. Your loved ones could not come see you. I mean, Greg, I don't know about you, but if someone says, hey, you can't go see your mom, that's not going to fly, right? That you lose a competitive advantage right there. But most of all, so senior housing is an operating business. Your operator is your most important. And then you have your staff. Right? Who is taking care of your mom? Who is taking care of your dad? Who is taking care of your loved ones? The staff is the biggest component. And what we saw during the pandemic was that labor shot up. We're in LA. Labor has to be, I'm sure, for the Chipotle worker, $23 an hour, right? If we say what's down the street. We compete most in senior housing with hourly labor with the Chick-fil-A's and the Chipotle of the world. So if they went from paying $16 an hour in 2016 to $22 an hour on average across the country, by 2020, our labor shoots up. So that's 60% of operating costs. So all of a sudden you have increased labor. You also have to bring in temp labor because if they were sick or if they tested positive, right, they can't come back. And so think of that like travel nursing. It's almost double or triple what a normally hourly pay would be. So your labor shoots up. You can't increase revenue because you can't move anyone in. And you can't increase rents. There's a rent moratorium. And then on top of that, what most people tend to forget about is senior housing is not considered a core asset class. So that means for financing, we do not typically qualify for fixed rate financing. So 90% of senior housing is floating rate debt. So you have senior housing owners who right, pretty simple math, revenue's down, expenses are up, and then you get hit with double or triple debt service, and you just find yourself underwater. But one of the things that no one likes to talk about, myself included, is senior housing was slightly overbuilt going into the pandemic. So senior housing was not tracked on the major indices or even Green Street or what those trends were until the early 2000s. So if you look at multifamily data, if you look at office, industrial data, that goes back forever. 80s, 90s is when we started tracking that. Senior housing was not tracked. Everything was tracked as when is the population going to turn 75? The baby boomers. That is the demand we're looking for. I think most everyone at ADISA knows I went to Alabama. Nick Saban's 75. 75-year-olds are not the target market for senior housing. So when we model after 75, that is when the supply started outpacing the demand. And so in some ways, we finally have a reset from COVID where there's no new construction starts. There are a lot of older communities or facilities that are shutting down. And now you finally have the first baby boomer turning 85. I think it started last year. So 2024. So we are finally caught up with that. And so it was a reset that the industry needed, but it was very tough. You saw a lot of operators who went out of business. If you were not well capitalized, you saw constrictions on lending. So if you think back to Silicon Valley Bank, that crash, all of a sudden your lender stopped saying, hey, we're going to let you skip a payment, or we're going to work with you on your debt service. We're going to reset your covenants. That stopped. So the tightening of senior housing owners being able to hold on to try and hit this rebound really constricted from 2022 to 2024.
Wow, that's a lot going on. And thank you for walking us through that history and perspective. I've heard little tidbits here and there, but that was a great level set of what has happened. Right now, what's our current outlook? Where's the market today? Where do you think we're headed?
We finally have the wind at our back. So Green Street is reporting senior housing is going to outpace in NOI. They're going to outpace in demand. As far as private equity flows into senior housing, that is expected to outpace from 2025 to 2029. So where we see ourselves going now, right, we finally have a reset of there's not enough new units coming on. And the supply or the demand and the baby boomers are now wanting to move in. They are getting to that point. So what we see in senior housing, it is needs-based. You are not saying, hey, one morning I'm going to wake up and this is what I want. It's typically something that it's time. So that time has finally come. So you're not saying I'm going to put this off for a year and see where the economy is. So for senior housing, we find ourselves in a unique position in today's economy and going forward where the age has caught up and the needs have caught up. So despite where everyone's at economically or where we are at as a country, people are still going to move into senior housing. Furthermore, we have a unique advantage compared to other asset classes as far as what we can do with NOI growth or what we can do with rents. I think what you're starting to see over the last year with uncertainty, there was a lot of rent bumps coming out of the pandemic across industrial, multifamily, and seniors. That has slowed down for other asset classes because senior housing is needs-based and because it is such a touchy-feely care aspect to it. People understand that they want the best caregivers taking care of their parents. So when they see a 5, 6, 7% rent bump in years of a recessionary time period, that is not as balked upon as opposed to multifamily because, again, the demand's there and the quality of what is expected for senior housing is just continuing to grow. So we find ourselves in a unique position going forward from I would say, momentum as far as where we see that population going.
From what you just said, if the stock market is a predictor, I think the S&P was up close to 10%, but the REITs focused on senior housing were up significantly more over the last year. Can you talk us through that?
Yeah, so if you look at Welltower or Ventas, they were up 60% compared to public markets just in 2024. So I would say quietly or maybe not so quietly the last 6 months, Welltower specifically as well as Ventas have spent the last 2 years acquiring billions of dollars of senior housing at a 7% cap rate with well below replacement cost. So what you are seeing is that their NOI growth was up over 18% last year and they're projecting 18% NOI growth just this year as far as operating margins. And they're being rewarded from that in the public markets. And they should be, and they will continue to be because their acquisition timing is now becoming apparent to their investors and to the other market indicators, and their performance will follow that.
Thank you for walking us through that. Now, you mentioned earlier about being overbuilt, kind of going into the pandemic. There's probably been a lack of senior housing development, but this is needs-based. So you have to be a little bit ahead of the game, I would think, in development so that when the need arises, people can move in. What does the pipeline look like for senior housing?
Yeah, so senior housing has had 20 consecutive quarters of negative supply. So no construction. Construction for senior housing, again, it's very hard because you are not getting your major debt providers in general for senior housing. But on top of that, most people after the pandemic and even before want to see development experience. So you have to have development experience to go out and get a construction loan for senior housing, and a lot of people want to see personal guarantees. The benefit to the alternative market is your public companies are typically not going to go put out a personal guarantee, right? The owner of Welltower is just not going to do that. They're going to put up their company assets. So therefore, they are going to be acquiring acquisitions as well as stabilized properties. And the benefit to our space specifically is that we have smaller pools of equity that are willing to put up those personal guarantees and do that. So if you are in the construction market for senior housing, you're going to be in a good position. That said, there is not a ton. So the starts are down. So again, the supply demand, and that's where you're going to see Welltower benefit, or anyone who's been doing these acquisitions, you're not going to have any new competitors come to market within the next 3 years. So a typical senior housing build takes about 3 years in general. So we are just now starting to see some construction starts, which means at the next 3 years, you have no new competition coming to market. So anyone who's outlasted the pandemic or anyone who did build and open right before or is opening right now is just going to dominate the market. So as far as where we are going, we are going to need more supply and demand. Or we are going to need more new construction to come. It's just not going to come quickly, and it's not going to come fast enough. So that is going to be a huge benefit, at least for the next 7 to 10 years. And again, if you don't get construction starts up this year, you're looking at a 5-year runway for anything that is already currently operating. So that's where those asset classes will outperform, and that is why they are able to drive the higher margins and increase the prices. And that's why smart money is following that as far as where private equity money is going into real estate, again, with those Welltowers and the Ventuses of the public markets.
Well, thank you for sharing where the smart money is going. That's a key insight for sure. Speaking of smart money, I mean, what are the best ways to invest in senior housing?
Yeah, so we talked a lot about how operationally heavy senior housing is. And so that is one thing I would say to investors, to advisors, to anyone who's looking at senior housing. It is really operationally heavy. So your downside swings can happen very quickly, right? With the pandemic, that was something that was never projected. If your operator starts to falter, that is going to directly impact your bottom line. So with senior housing, we typically say it is better to find a growth-based senior housing. Trying to find senior housing at a income producing, say, a 7% to an investor annually, that's pretty hard. You're probably overpaying on your price per unit. So we typically say when you look to invest in senior housing, find something that is more of a growth component, find something with income, find something that is a longer hold. That's where you're going to really increase margins. That's crucial in senior housing, is just pushing increased margins to get value out of those properties. So as you're looking to invest in senior housing, look and make sure who their operators are. You typically want smaller operators if you are investing in smaller funds. You want to know that you have that control, right? This is your money. You want to make sure the operator is aware of that. You typically want to invest not in California. I know that's controversial. Typically not in Texas. Those still markets are a little bit overbuilt, but there are going to still be good deals that pop up right all over the country. But you're typically going to want to see that southeastern market. The southeastern mid-Atlantic is just crushing it as far as where people are going to retire. So I would look in those areas and again, look for funds or investment opportunities that are more focused on growth over income, because that's going to protect your capital during any questionable times in the operating life.
Great, Jade. I think we've covered a lot of ground. Any other last words of advice for financial advisors when considering senior housing?
No, I would say you guys probably do have a lot of clients who are aging or whose parents are aging and getting into this phase of life. So we definitely say we're happy to help as far as what that looks like. Make sure you are asking the right questions as far as what level of care you're getting as parents, as loved ones are looking into senior housing. Make sure you are, again, looking with those smaller operators. That's where you're going to get your best care. So that's not investment advice. That's just senior housing advice. But happy to help with anything on that.
Jade, thank you so much for walking us through all these different aspects on senior housing.
Of course. Thanks, Greg, for having me.
And thank you for listening to another episode of Focus on Alts. Again, for more content like this, please visit the resource library at ADISA.org, and we'll see you at the next episode.